Hello and welcome to Say Hi to the Future, Ingenious Thinkers, a podcast aimed at highlighting the human side of ingenuity. My name is Ken Tencer, curator of Say Hi to the Future, helping leaders think differently in the face of uncertainty and ambiguity. Better thinking, better outcomes. With me today is Omar Abedin, Global Advisory Council member at SuperFounder. Omar Abedin, welcome back to Say Hi to the Future.
It's great to be back, Ken. How are you?
Good, good. So Omar, we've talked a lot of times now, and I know that you've been part of the startup world for so long. What's new? What's different out there?
Oh, there's a lot going on, Ken, as you can imagine. So, on the investment side of things, it's a very gloomy picture. 2024 is expected to be as bad as 2023, which is pretty bad from an investment standpoint. So we're going to see, small amounts of funds being deployed. We're going to see, unfortunately, a lot of startups coming to, a close. They're wrapping up operations simply because they've run out of funds, they've run out of runway, and they haven't been able to raise successfully in this climate. On the startup side, the challenges are immense to become profitable, to start, generating cash flows, possibly much faster than they had ever envisioned when they were setting out on this journey. So the pressure on the founders is to continuously pivot and evolve and come up with new ways to become cash flow positive, because it's either that or sayonara. And so, it's going to be a really tough choice. Founders are going to have to buckle down. The good news is that the founders that come out of 2024 are going to come out as completely different animals. They're going to be a different, their DNA is going to be completely different. They'll be lean, mean. They can take on the world. And when funding opens up again, they will be in a very good position to scale. So it really is survival of the fittest at this point, Darwinian law at its best and worst. And the people who make it to the end of the year and into the middle part of next year will find, I think, a much more hospitable environment than the barren and godforsaken one that exists right now.
Well, that's a happy start, Omar. Um, but let me ask though, you talk about pressure put on founders. I find a lot of it is unrealistic from the get-go. And I think, in my mind, I think that might be causing more failures than necessary. And specifically, the great hockey stick, boom, and revenues have to go up. I've been in business a long time. Boy, there are few to no hockey sticks that exist in business. So if we start out with an unrealistic pressure, our financials, our projections are unrealistic. Our capital requirements are unrealistic. So are we setting ourselves up for this failure you're describing?
So since we just crossed Easter, I'm gonna go in with an egg-related joke, right?
Okay.
So it's all about managing expectations.
Mm-hmm.
Um, I'm sorry, I couldn't resist. It's just it's too soon, I guess. But expectation management is a skill that not all founders have learned. It's very easy to make grandiose projections, and then when you fail to achieve them, it seems like the sky is crashing down. You may have a perfectly viable business growing at 25 to 30%, but since you committed 300%, you look like a failure. If, on the other hand, you'd committed 20% and grew at 30%, you'd be a rock star.
Right.
And so the challenge with that is that if expectations are set at 300%, then VCs and other investors are looking at different returns on their investment. And their timelines are, crunched as a result of that expectation as well. So in my view, it's always better to be conservative when it comes to your financial forecast, and aggressive when it comes to your cost estimates, because everything is going to cost more than you think it is.
Mm.
And your revenues will always be slower or will lag where you think you're going to be. So, if you apply those two parameters, you come to a much more realistic picture of where the business is likely to be. And it's much, much better to go in with an investor who is informed and expecting, let's say, 20% growth and delivering 30% against that, because that investor is going to go out and talk to 10 other investors and say, by the way, I have one rock star who told me he was going to do 20 and did 30. You guys want to meet this guy? He's phenomenal. You know what I mean?
Yep.
So it really falls into this age-old problem of expectation management.
So let's talk about those rock stars for a second. I used to think, and I think we used to believe, that entrepreneurs were young and aggressive and whatnot. And more, I read about people who might be in their 50s, who are, still who have a lot of energy left, who have incredible insight and experience behind them, becoming some of the newer rock stars in entrepreneurship. Are you seeing that?
So, the urban myth of the dropout um, graduate student from some Ivy League school somewhere, going out and founding a Facebook or whatever, that is, I mean, the numbers are not, don't back that up. So
Mhm.
the data shows us that most successful founders now tend to be at least in their mid to late 30s. They're people with some experience, either of working in a particular vertical where they become subject matter experts and therefore have found a gap that they want to fill or a problem that they want to solve, or these people have worked in startups, over the years, multiple startups sometimes, and are coming to a realization that actually there is an opportunity in this space, and that's what they want to work on, and that's how they kind of come to that problem. But all of these people, and especially the ones that I work with in my venture studio, the people that I love working with the most, which is actually all of them, are people in their 30s and 40s. These are people who are mature. They've been slapped around by life a little bit. They know what it's like to get punched in the face. Like Mike Tyson said, everyone has a plan until you get punched in the face. So the first punch you get in the face is when you decide, are you going to get back up, or are you just going to lay there and let the ref count to 10?
Right.
So these are people who've been punched, they've been pushed around, they've been around the block a few times, they've bought a few t-shirts, they've got a few hats, and they now know what they want to do. And they may not succeed the first time around, but they will learn from that and they will do something better and then better. So first time, flash in the pan founders are so unique. I would call them unicorns rather than the billion-dollar valuations that they have succeeded with. So people generally that I found are, on their second or third iterations of businesses over a period of a decade or more. And these are people that are open to feedback, they're open to coaching because they know enough to know that they don't know everything. Young
Right.
people, unfortunately, tend to have sometimes overwhelming self-belief in the face of all odds, all evidence to the contrary. They believe that they are, um, God's savior. I mean, they're going to save the human race from themselves. And you know what? One in a billion might be that person, but the rest of us have to work for it, and it's a process. So it's not that I'm uh, against young founders. I mentor and advise lots and lots of young founders, but I'm advising them with the belief that they will become something else. I'm not necessarily investing in the person that they are today. I'm investing in the person that I hope they will become 10 years from now. So I kind of take a long-term view on that.
Yeah, and when I hear that, I look at my own journey and those of so many, well, I don't even know how many entrepreneurs I met. It's that transition from overconfidence to an informed resilience, I would call it, that I think really helps us understand that, okay, we're bright, we're confident, but it's getting up in the morning, as you said, and taking those hits and keep on going. But you just a switch here. You mentioned your venture studio, PTH Venture Studio. Tell me about that. It sounds like an exciting new direction.
Well, it's something I've been working on for a while. And now, it's kind of the focus of everything that I'm doing. So we work with founders to help them to build sustainable businesses. And I actually had a very long conversation with someone a little earlier in the day today around what are the things that differentiates the PTH approach versus, anyone else. And so I had to think a bit, and I came up with three differentiators. The first was that we are really focused on how big the problem is that the founder is working on. So
Mm-hmm.
if it's something that's going to someday be a $10 million business, it's a lot less interesting to us than if someone is doing what we call a moonshot, right? Something that
Right.
could potentially change the way an entire industry works or entire vertical works, or in some cases, the way, the world operates in some small way, right? So we love those. And actually, three out of the 7 or 8 companies we're working with right now, I would classify as moonshots, which is crazy because no other startup studio that I know of has that ratio of moonshots in their portfolio. The second thing we look at is the founder themselves. And here it's really all about the vision, the mission. What are they trying to do? And most importantly, why are they trying to do it? So we work a lot on understanding their chemistry and seeing whether we have chemistry with them. So the founder is absolutely integral to everything that we do. And the third area is the how. Like, how do they plan to achieve this, right? Because I'm I'm a little less worried about business models than many of my peers, simply because business models are theoretical until they launch. And then you iterate the hell out of them every single day. So a year into the launch, the business model of any particular startup might be entirely different. They may have pivoted 5 times. They may have gone into new target audiences, new markets, new products, new services, new offerings. So getting really hung up on a theoretical business model to me is not essential. I think you need to know that the founder has a path that they're following, and that
Mm-hmm.
trajectory looks like this. And if and just for us, if we have a founder who's working on a cash burn model that requires external funding for the next 10 years, we will not work with them. We just won't do it because we believe that you've got to build a business that can work without external funding. Otherwise, you will die at some point when external funding dries out, right? Which
Mm-hmm.
is which is exactly what's happening right now. And I think these cycles that we're seeing in the startup ecosystem are going to be as obvious as real estate cycles. So real estate cycles, as you know, come along every 14 to 16 years. There's a boom, bust, crash, well documented for the last, I don't know, 80, 90 years,
Mm-hmm.
and perhaps even longer in real estate. I think we're going to see a similar cyclical business pattern in startups as well. So you don't want to build a business today and have it go under 4 years down the line because you just couldn't raise funding anymore. So those are the three things we look at. And it's interesting. I have met over 1,000 founders in the last 3 years, and we've partnered with 7. So checking all those boxes is not it's not a form filling exercise. And in
Well,
some cases, by the way, I've actually taken equity from founders and realized I've made a horrible mistake. And several months into the process, put my hands together and said, here's your equity back. I'm so sorry. It's our mistake. It's not you, it's us. We wish you all the very best on your journey, but unfortunately it's going to be without us.
wow,
So
that is a very different philosophy, but I really I admire that a lot. And Omar, what I heard was you like to invest in businesses and not plays. And what I mean by this, and I was skewered years ago in one of my, Globe and Mail articles that I had written in Canada, just talking about burn rate's not a ratio. It's not a business ratio. It was a crazy concept that led to a major crash, obviously, and a loss of a lot of equity. For me, a business is something that, yes, you can shoot for the moon, and if you only make it to the space station, hey, that's pretty good. but that requires, as you said, eventually making a profit, returning money. It isn't just about cash burn. It isn't just about rapid scaling to nowhere in many cases.
Yeah, in the past, it's been about scaling for the sake of building the numbers so that you get acquired. So, I mean, I've been, I don't want to be a hypocrite. I've been the beneficiary of exactly this thought process when I was at Kareem. We were hyperscaling across the region. We were in 14 markets. We had, at one point, close to 30, 40 million monthly active users on the platform. And my budget was 100 million US for the year of marketing budget, right? Customer acquisition, captain acquisition, retention, all of that. And that's crazy. That's like taking several container loads of cash and setting it on fire. But that play worked out in that environment. The company exited in 2019 for $3.1 billion to Uber because Uber finally said, you know what, we're done fighting you guys. We're just going to buy you. And so they negotiated a sweetheart deal with Uber where the company still exists. It has its own board. It's run independently. The brand is still functioning in all the markets. It's done really well for itself. But literally 2 years later, the same deal would have crashed and burned.
Right.
And the company may have just gone under because of the timing. So timing is, as you know in life, and timing is everything. So the timing of this deal, the way it was put together, the leadership of the founders, Mudassir and Magnus and Mohammed, it's just phenomenal. They led it through the process. They played their cards very close to the chest. And the result is there's a diaspora of Kareem people across the region, fondly called the Kareem Mafia, after the PayPal Mafia of the early 2000s, that have created 200 companies across the region. So that's been the fallout, right? The fallout has been this mushrooming of companies across the entire Middle East, Pakistan, Africa region, and it's been phenomenal for the ecosystem. So you can argue. I mean, was it a good thing? Was it a bad thing? It was a thing, a
Right.
$3.1 billion thing that just changed the ecosystem permanently. Could you do it today? Probably not.
Well, pumping that type of money back into the individuals that were involved seems like a very good thing for what it spawned. So, I, Omar, can you talk to us about some of the ventures that you're working with at PTH? Some of the things that you see might be moonshots.
Yeah, sure. So um, let's start with a mineral company, right? So this is a mineral aggregator called Z Minerals, working along the most fun hotspot in the world, the Pakistan-Afghanistan border, which is, has been a contentious geopolitical location for a century at least. Many wars have been fought in the region over the mineral wealth of the region. And so this company is one that I believe will achieve a massive impact in the region, not only because of the fact that they will be able to, based on their innovative business model, they will be able to actually get those natural resources to market very cost effectively, but they will have a massive socio-economic impact in the region. So they will be building roads, bridges, dams and water infrastructure, school infrastructure, primary healthcare, secondary healthcare, testing laboratories, all kinds of things. So tree plantation, that's a barren area. There's no trees. It's a desert and mountainous area. So you're literally changing the way a people live because it's a very small population in a very barren area that happens to sit on $30 trillion worth of minerals. That's the number. Those are the documented numbers.
That's
$30 trillion,
that's a
right?
number.
That's a number. That's a heck of a lot of zeros, right, Ken?
Yeah.
So this is a company that, for example, I believe will be a moonshot. The second one I'm working on is that the complete opposite. It's a Web3 tokenization platform for real estate based in Dubai. And the idea, again, there is to actually help people get onto the real estate ladder by selling tokenized real estate. So all the investments are collateralized because you actually own the property. You're able to deliver an annual return on the investment as well. And you're selling tokens that get traded and then have an inherent value of their own. So again, this is one of those projects that I believe, I mean, you know that real estate represents 85 to 90% of all the wealth in the world.
Right.
Everything else, gold, silver, every possible precious metal ever taken out of the earth on one side, and real estate is 9 times bigger than everything else globally.
Those
So
are, yeah,
those are numbers, right? I mean, you
those
can't argue with
are.
that. And it is inevitable that real estate assets will move on to the blockchain at any point in time because they are actually the perfect assets to go on the blockchain. They're high value, they're extremely important usually to the buyers and to the sellers. And maintaining ownership is going to become increasingly complex in this modern day world. So if you're able to move those assets onto the blockchain and then tokenize them, there's a massive, massive upside on that platform. So that's a second one that I would call transformational. The third one is a student recruitment platform that is disrupting university recruitment around the world. So this is a team of 200 people working on a volunteer basis until now to build a technology that connects students to universities directly without the middleman. No agencies, no agents, no intermediaries to help with, or to charge students funds. So it's free for the student, right? The student creates a profile. We partnered with a development organization out of the US to provide those students with $1,000 subsidies. So when someone signs up to the platform, they go and create a wallet on this development partner's platform, and they receive $1,000 in the wallet. Which, if you know, in Africa, like our
Right.
main
Completely.
university student target audiences are in Africa, South Asia, Southeast Asia, Latin America. You're talking about markets where $1,000 is a
Yeah,
lot of money,
it is.
right? So the plan for this company, for example, was to sign up a million students in 5 years. Because of this deal that we've signed, or in the process of signing, we've actually truncated that to a year and a half. We think we'll get to a million students in a year and a half. So if you have a million students and you have, let's say, 500 to 1,000 universities signed up, you become the single biggest provider of student tourists into any of these markets. And the biggest market in the world for this is the US, but Canada, Australia, and parts of Europe and the UK obviously are, the beneficiaries of this.
Right.
And this also gives those universities a way to talk directly to students through the app. No more advertising. You don't need to waste money on Facebook or TikTok or whatever it is you're doing right now. Talk to the students directly through the app.
What I am hearing is that we are going to have to build a second moon just for you. Those are three
Yeah, I mean,
wonderful examples. So, we were with Omar Abedin, founder of PTH Venture Studio. It's amazing. Our time has flown by once again whenever we talk, but there's one thing that I really need to ask you before we sign off today. Talk about your role as a SuperFounder global network brand head.
oh, I love this. So, SuperFounder Global Network has been founded by a couple of crazy people by the name of Jeremy and Esther out of the US. And I say they're crazy because it's the crazy people that change the world, right? So Jeremy and I have been working together for about a year, and he's actually an advisor to some of the startups at PTH Venture Studio as well. So Jeremy came up with this idea of mentoring and advisory services at scale, right? So not mentoring one-on-one, but mentoring 1:1,000, 10:1,000, 10:1,000,000, at that
Right.
kind of scaling.
Yep.
So the idea there is that they're creating a Slack channel. It's going to be a paid Slack channel. It's not for free. So it's not really for your very, very early stage founders who have who are bootstrapping and probably don't have revenue at this stage. It's for startups that are somewhere between a million to probably 100 million in revenue.
Hmm.
So in one place, you can go talk to global experts, people who are recognized experts in their fields, whether that be fundraising, whether that be investment strategy, whether that be marketing, branding, business development, technology development. So there are more than 70 experts that are going to be on the Slack channel available to answer your questions. So you can literally go in there and say, hey, at Omar, can you help me with this brand strategy? I'm struggling a little bit as to how to position ourselves relative to, competition in this space. And so you get to engage with me basically for free because you're already paying for the Slack channel, right? And I'm committed to trying to answer as many questions as I can. So brand head basically means if you need help with branding, whether that be corporate branding, employer branding, or personal branding, because as you know, I've written a book on personal branding.
Right.
You can talk to me, and I will answer your questions, and I will try and guide you as best as I can. And similarly, there are such amazing people on this SuperFounder Global Network. Ken, you got to go check it out. I mean, some of these people are unicorns. They're you can't find them except on a stage somewhere, either in Vegas or in Austin or maybe in Dubai, sharing their views with hundreds and thousands of people listening to them. These people are on this platform as mentors and advisors. So
Hmm.
my hat is off to Jeremy and Esther as founders of this thing. I am part of the advisory council of super founders. So there are 17 of us that are actually like the core members of the SuperFounder Global Advisory Council. And I'm super psyched about this because
Hmm.
think about the impact. Think about the fact that you can actually advise not one, not 10, but 100, 1,000 startup founders at the same time. It's mind blowing. And me, this is, in my view, this is a moonshot project in and of itself. So,
Right.
I I I love stuff like this.
And so you should. Omar Abedin, thank you again for being part of Say Hi to the Future and for joining us today.
Ken, it's been a pleasure speaking with you as always, and I look forward to our next session.
Absolutely. Take care.
You too.